Good morning, everyone. We're 1 hour into the trading session on Wednesday, September 18th. And of course, the entire financial markets, everyone is focused on the Fed announcement that is going to happen later today at about uh, 3.5 hours from now. So let's see what's going on in the markets. But so far, it's been really muted. You can see that over intraday, you can see, well, let's look at on the day basis first since we're here, that we opened a tiny bit higher and then we've drifted downwards. We're 0.02% below where we closed yesterday. Really nothing. The market hasn't really gone anywhere. And we're not even seeing the huge volatility range that we've been seeing leading up to this. And that's because no one wants to make any bets before, excuse me, before the announcement. So we do have a little bit of a downward bias. We've been drifting lower. It's just very, very muted though. So by this time yesterday, 7:30, let's take a look what the movement looked like. So 7:30 yesterday was from here to here. So far we look like this maybe as compared to this morning. We haven't had a big movement upwards like we did yesterday. And of course, yesterday became very directional. And today's chart could look very similar, where we're very muted. And then at 11 o'clock over here, or 2 p.m. Eastern, suddenly you start to get a lot of movement and perhaps a directional movement. So don't expect too much movement ahead of 11 o'clock. After that, we're probably going to get a spike one way or the other. Then we're probably going to correct that spike and then we'll pick a direction. So this is going to be difficult for people to trade no matter what, whether we're trying to day trade this morning, because look at this tiny range that what is there to trade? If I try to trade the VWAP, we only go down to here. I'm not going to make very much money for the risk that I'm taking. So this is really just a sit and wait and see what happens, or get prepared, prepare your portfolio for what's about to happen. It's a quiet time period that we can take advantage of to make sure we're positioned properly. Now, I know everyone is focused on interest rates because of that Fed decision, but for me, there's one thing that I'm thinking the most about. And you can see, look at this volatility. Spike in the morning to 19.4. And even though all we've done is drift sideways and we're basically flat on the day, we're still here up above 19. Yesterday we closed at, well, that was not yesterday. We closed at, so all the way back here, we closed at 17.8. So just in the overnight session and in this first hour, we're all the way up into 19. That's what I was talking about earlier this week. If nothing else, you're going to experience volatility. People are focused on interest rates, but the real story is volatility, because it's not just the Fed. This morning we had a VIX expiration, VIX options expiration. So that introduces volatility. Then we have the Fed interest rate cuts. That introduces volatility. Then we have quadruple witching on Friday. That's going to introduce volatility. No matter what, we have volatility. Volatility is in the DEX. So we want to make sure that, one, we're positioned well for volatility. So that means taking a look at our portfolio, looking at our existing positions, looking at the option strategies that we have, and making sure that they do well, or at least neutral, in a higher or heightened increasing volatility environment. After you do that, then you decide, hey, am I going to trade this? Do I want to sit on my butt and do nothing while the Fed makes its or announces its decision? Or do I want to make a trade or make a bet on how it's all going to play out? If you do decide that you're going to make a trade, then you want to take that volatility into account. You want to benefit from that heightened volatility. But if you're going to do that, you also want to be very quick, because after all the volatile events, the volatility does have a tendency to correct itself very quickly. So just look at these spikes over here. The Japanese carry trade, just in the same day, it went super high and then started to correct itself. It made a significant correction to itself same day. Then over the next 1, 2, 3, 4, 5 days, we came all the way back into this range over here. Same thing happens every time we spike up. 1, 2, 3, 4, 5. This one, 1, 2, 3, 4, 5, 6, 7. We resolve ourselves fairly quickly. So that means that if you have positions that do benefit from the volatility, you want to be able to take your profits fairly quickly within the first few sessions, because all of that benefit that you got from the volatility increase is going to go away very quickly. You may also have benefit from a price increase or a price change, then but the volatility component is going to go away. So you'll see your profit go up and then swing back down. You may net still profit, but it's not going to be the same. So just be aware of that volatility moves very quickly. And if you do decide to play during a volatile environment, you want to take profits quickly. Now, if you happen to get really hurt during, then it depends on your strategy, because if you get hurt and then heightened volatility was benefiting you. So just say you buy a long call on the S&P 500 and it actually goes down. The S&P actually goes down. Well, the heightened volatility was helping you not lose as much money. So once that volatility comes back down, you're going to end up losing even more money. So even if you don't end up making money, you want to just close out your positions very quickly, as long as they're the type of strategy that benefits from increasing volatility. So just be aware of that we probably want to take fast action after these events. So after today, you may consider it, but we do have quadruple witching on Friday as well, which will create a lot of volatility. So that's going to be the main focus right now. There, you could try to do interest rate plays, but you know what? Interest rate plays out over a long period of time. You may be able to catch a quick gain or a quick profit right now, but those profits, if this is a changing environment, the interest rate is changing, so that is going to be a lasting environment. We have had our current interest rate has been held steady over the last couple of years. So that is a steady environment. Once that gets baked into the market, then you're operating under that for quite some time. So the benefit, you have time to benefit from it. But something like volatility, it comes a couple days and you just have to be able to take advantage or make sure you're not too hurt on the reversion of it. So I'm going to be more focused on volatility than I am on interest rates. Interest rates are going to be interesting. They'll tell me what sectors to focus on. So speaking of that, let's take a look at what can get this. There we go. Let's see what's going on with our sectors. And you can see very, very muted. The largest sector movement to the upside has been just all random, but the only one that's kind of maybe becoming not random is biotech. And then to the downside, also quite random. And then when we get over here, there's a few a little out of order. So interest rate sensitive, home builders, financials, interest rate sensitive, XLB, not really not that sensitive, but for some reason is reacting. XLK sensitive, SMH sensitive. So we're seeing the opposite reaction from the last couple of weeks leading up into the Fed announcement. We're seeing the opposite reaction this morning, but again, it's fairly muted, especially compared to the movements that we've had in the last couple of weeks. So I wouldn't read too much into this. Just know, I'm going to reiterate, it's going to be very difficult for the Fed to navigate this particular rate cut. If they do 50 basis points, a lot of people are going to be upset or put into fear that something hidden is going on. If they do 25 basis points, well, the market baked in 50 basis points. So there's going to be disappointment that we didn't we didn't get as much as we wanted. If we do no rate cut, well, no one was expecting that according to FedWatch, according to the market prices. So that is going to disappoint people. And don't even consider increasing rates or 75 basis point or more cuts. That's just not even on the table. That's basically zero or as close to zero probability as you can practically get. So we're still in this market, still heightened, higher expectation, higher probability priced in of a 50 basis point rate cut. It's going to be very, very difficult. The Fed has to cut the perfect amount, which in this case, the way that this market is positioned right now is probably 25 basis points. It's going to be very difficult to, if they cut 50 basis points, to be able to manage the disappointed people. But if they cut 25 basis points, they could, in the announcement afterwards, there'll be a disappointment, there'll be a drop in the market probably. And then the Fed will come in and speak, and what they could say to kind of ameliorate it and bring the prices back up in the markets or appease the markets is, oh, it's just the first. It's just the first of many. We fully expect to keep on cutting rates. We want to make sure that we have measured moves and that we calmly move into the rate cut cycle. Then something like that would start to calm the markets, and then you could possibly navigate this well. Now, even if we do react well to these interest rate cuts, we're near or at all-time highs. We can move even higher, but there are a lot of signs that this market is overextended. Overextended means it's got to pull back a little bit. Just like this was overextended, it had to pull back or make a correction. This was overextended. It had to pull back, make a correction. So this is now, if we move even higher, that's going to be overextended again. We have to make some sort of downward motion. It doesn't mean that we're going to crash or go downward, but we're going to have to make at least some sort of downward motion before we can get bullish. But the next big thing, the market is always looking at the next catalyst, the next thing, the next known event, and that is going to be elections. So we can't expect this to go screaming higher because there's a huge uncertainty event or uncertain event that's coming up in November. So this isn't going to go hugely up. It's going to move up if we get a positive reaction from this Fed announcement, but it's not going to go sky high. It's going to be measured, and then we're probably going to chop sideways into election again. Now, if the Fed handles it incorrectly, or I should say that differently, if the market reacts poorly to the Fed's decision, then we start moving down. This starts to look like a triple top, and then we come down to challenge this low over here, which happens to be very close to that MA 200, and then we have a decision point. We could chop sideways into the election again, or if we drop downwards through that MA 200, it is possible that we start to move into a bear market, especially if what the Fed does and says causes us to start fearing recession. Now, the way this is starting to play out is reminding me a lot of 2007. And 2007 is burned into my mind because that was the beginning of my trading career was January 2007, and then the financial crisis started in September of 2007. So I was brand new trader. I was an analyst before that, but in terms of getting licensed, getting my Series 7, my Series 55, becoming a trader institutionally a trader, that was January of 2007. And so I was brand new. I was only a few months into my career, and the financial crisis starts to happen. And so the picture of 2007 is burned clearly into my mind. And this looks and smells a lot like it. And even if we do get exuberance from, say, a 50 basis point rate cut and we start to move higher, that could just be the last hurrah where everything starts to come down. Because why? Why 50 basis points? We have to keep asking ourselves that. Why 50 basis points? Because job joblessness is supposedly at a near lows, and supposedly our economy is doing very well, and supposedly inflation is, well, I guess inflation coming down is the appropriate reason, but supposedly our economy is doing very well and our jobs are doing very well. So there's no reason to stimulate. Cutting rates is stimulus. So here's the secret. Here's the big secret that no one will tell you, and that this is from my directly from my experience being on short-term money markets desk, analyzing the Fed and having to respond to whatever the Fed was doing. But that was my job. Respond to what the Fed is doing, profit from what the Fed is doing. And at least from the profit perspective. There's a whole bunch of other portfolio stuff that I had to do also. But from my main job in terms of generating profit was follow the Fed and profit from what they're doing. So the secret that I'll tell you is that everyone thinks, and in textbooks and in principle, that the Fed is supposed to stabilize markets and the economy. And the truth, the unfortunate truth is that's not what they do. And that's not their true purpose. And that wasn't their founding principles on which they were created. We have to remember that the Fed was created in the early 1900s, I think 1914, 1917, right around that area. So, and who created them? And how are they created? They were created out of a banking crisis. And a senator was sent to punish the bankers and tell them you can't take this kind of risk. Instead, that senator got together with all the heads of all the banks. They had a meeting on Jekyll Island, and they came up with this thing called the Federal Reserve, which was a bank. And this was supposed to that was their response to the banking crisis. What it was putting power into the hands of bankers so that they could control what to do. So in other words, the Fed was created to benefit the banks, not the economy, not the markets, the banks. So if we get a 50 basis point rate cut, what I'm going to be starting to look for, you'll see my focus shift. I'm going to shift to financials. Everyone else is going to be, hey, this is so great. Consumer discretionary, luxury items. You know, people who are it's going to be easier to finance things. Let's go buy homes. People who were sitting on the sidelines with purchasing power, now they're going to be free to buy the luxury goods, the Louis Vuittons, the Hennessy, the whatever brand names that they weren't splurging on before. Yay, inflation is over. Yay, we can go spend. I'm going to be looking at the financials, and I'm not going to be looking necessarily for them to go up. I'm going to look around and say, why did they need to cut 50 basis points? What is going on in the banking system that requires us to cut 50 basis points? What are the dangers that they see that aren't obvious to the public? So we'll go on a little bit of a Easter egg hunt and see what we can sniff out if we get a 50 basis point cut, because that is outsized and abnormal and not warranted by the economic situation, which means that they are not, and they're not doing it for political pressure reasons. So what are they doing for? They're doing it most likely for the bankers if that happens. So we're going to look very, very carefully at financials and at banks if this does happen. Remember, it wasn't that long ago where we were concerned about all the regional banks and we thought that we might have to bail them out. And miraculously, a couple of regional banks shut down and everything was fine. Do you think that situation was actually resolved? I don't know. I haven't looked at it for a while, but I'm going to start digging if we get a 50 basis point cut. So if you're interested in all of that, there is an excellent book called The Creature from Jekyll Island. Sounds like a gothic horror novel, but it is not. It's all about the creation and the formation of the Fed. Another really good book is The Grunch of Giants, I believe by R. Buckminster Fuller. Excellent book. If you want to understand Fed and its motivations, why it was created, how it operates, those two books are absolutely excellent. And I'm going to be utilizing the knowledge that I've gained from those books, but also the many years that I spent on the short-term money markets desk managing the entire aftermath of the financial crisis, because that's when I got onto the money markets desk was immediately after the financial crisis that I started trading the Fed. So I'm going to be leveraging all of that experience to go forward, assuming we get the 50 basis point rate cut. If we get a 25, I'm not going to be as suspicious. So we'll see. We'll see in a few hours. So make sure you keep your eye on volatility. Make sure you're well positioned for it. If you have anything that benefits and gains from volatility, make sure that you take your profits or your losses by, say, Monday or maybe Friday, because we still have quadruple witching. And then just hang on for the ride, because this is probably going to get pretty bumpy starting at 11 a.m. or 2 p.m. Eastern. Okay. Have a wonderful day, and I'll see you guys after the market to see how it all played out. See you guys later.